Welcome to the Wall Street Geek, where life moves pretty fast. So if you don't stop once in a while...
I'm not going to shut up. It's my turn. So anyway.
It may pass you by. We've all been there watching the stock market take a roller coaster ride in reaction to global events like the mortgage meltdown and the Eurozone crisis. Traders and analysts often refer to the VIX. It's the Chicago Board Options Exchange Market Volatility Index, and it gives you a read on how volatile the market may be for the next 30 days. We're in a relatively calm period now, but what if volatility increases, especially as the Eurozone renegotiates Greece's debt, and especially in the US, as we face these fiscal cliff discussions, and also as we face negotiations over the sunsetting of the Bush tax increases. Which sectors may perform the best if the market gets volatile again? To figure this out, you simply have to see how each sector correlates to the VIX. You can do this in Excel along with historical prices. The closer the sector's correlation to the VIX is to zero, the less likely that sector may be affected by volatility. I checked each sector's correlation over the past year, which captured moments of high and minimal volatility. Number 1, basic materials. This sector has stocks for companies that discover and manufacture materials like metal and gold used to make other things. It had the least amount of correlation to the VIX over the past year out of all US sectors. Its correlation was negative, so it tended to underperform when the market became volatile. Number 2, oil and gas. This sector had the second least amount of correlation to the VIX over the past year. Companies in this sector explore, drill, and refine oil and gas. Although oil and gas has been in the news quite a bit over the past year, especially as part of Iranian sanctions conversations, it actually doesn't suffer as much as other sectors when the market becomes volatile. Number 3, utilities. Utility stocks deliver gas, electric, water, and related services to consumers. It's usually where retirees invest, since these stocks typically have good dividends and minimal price movement. However, over the past year, these stocks have been more sensitive to volatility than the other two sectors that I named. Sectors that have actually been the most reactive to volatility over the past year include industrials, consumer goods, and financial services. These are almost perfectly negatively correlated to the VIX with the correlation coefficient of almost -1. The VIX has actually been going down for most of the year, which means that volatility has been decreasing for most of the year. As a result, since these sectors are negatively correlated to the VIX, these sectors have actually been trending upwards this year. That's not the only reason why these sectors have been trending upwards, but it sort of reaffirms the fact that they're negatively correlated to the VIX. As always, talk to someone that you know and trust before you invest, and nothing that I said in this video was a recommendation nor an offer to provide investment services. And thanks for watching, because as always, I want you to live long and profit. Take care.
Hey, Michelle Price here. Get my book and learn how to buy stocks online. It's available at Amazon or any retailer near you. Also get a free workbook at modernwealthmedia.com/video. That's my publishing company. It'll teach you how to create a budget, write a financial plan, and manage your portfolios. Get them both today, especially the book.